Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options trading platform built on top of over 15 years of historical options data. Our platform is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about caller strategies and how you can use them to protect your position. Matt, do you want to share a screen and get us started by going over our current positions?
Sure. Let me first show how I got an alert. So we sold a butterfly in SPY for 1023, and I got an alert that it hit max profit of 50% or 511. So we got out of that one. And then also, so that was this one I traded out of. And then the only other one that we had on is the IWM. We sold for a credit of a penny. And I believe we still have that one. It's gone against us a little bit, but it's so it's still kind of in a similar spot. So it's negative 18 cents. So we're doing okay. So those are the trades, Tyler.
Cool.
All right, let's talk about callers.
Yeah. So callers, they're an interesting type of strategy. They typically involve a stock position that you currently have on. A short risk reversal is the options form of the caller strategy, but without the stock. So you can use that in our options scanner. I'm sure Matt will show that.
Right. So a caller strategy, correct. Often we get calls and our clients are using callers to, if they have what they call a concentrated position, they have a certain amount of stock that they've had for a long time. They don't necessarily want to sell it, but it's risky enough to where if it went down that it would affect them and their overall portfolio negatively. So they often want to put a collar strategy on where you buy a put, so that protects you if it goes down. And then puts could get expensive. So what they'll do is, since they already own the stock, they'll sell a call and they'll have enough appreciation to where they're still happy if it goes up, and they're not too sad if it breaks through the upper collar. So I think the best way to kind of talk about this, Tyler, is to look at some examples. I have a collar strategy. I have NVIDIA. So I have a short-term collar and a longer-term collar here. And why don't you pretend like you are have a large portion of your net worth in NVIDIA stock. You've had it for a while, and now you want to protect it. So let's just kind of go through the thought process of a collar strategy.
Yeah, so, if I was trading and had a lot of money in NVIDIA, the first thing I would think about is buying a put. That's classic. Every options trader knows buying a put, protective put, protects you from the downside. So I'd buy it, pretty far out of the money, but not too far, where I'm going to get screwed. But I want it, far enough down where I can ride some lows on the way up, right? Because I'm a strong believer in the stock.
Yeah. So NVIDIA, it's over the last 2 years, maybe you bought it at 150, now it's at 210, 208 or something. So what you would do is you'd sell a put somewhere down here, and you'd buy a put down here to protect you, and then you would sell a call up here. So, any thoughts, Tyler? Like, so, we have these trend lines. The trend line's about I call it 200. And then the upper trend line is 229.
Yeah. Well, you're looking at IWM there.
Okay. Thanks for I know. I was like, I thought it went up a lot more. So you might have owned it here at like 13, and now it's up at 105. So, and then our trend lines are at 95, and then way up here at 157. So
Yeah, so I mean, buying a put at 95 doesn't seem like a bad idea, and that trend line looks pretty strong.
yeah. So would you do that short term? Would you do it long term? Like the problem with short term. So if you buy, let's just say you do a short term and you buy this 95 put or whatever, right? If it just trickles down to 95 over the next what is that 10 days, you're not protected. If it closes right at that strike, then you haven't made any money, and you have to then put another collar on, and then you go out of the money again. Then you go down to the 90s, and then you do it again. So to me, if I'm protecting a longer term position, I'm going out a little bit. Does that make sense?
Yeah, it does. You want to ride the sock a little bit, but
Right.
you don't want to lose your shirt in the process.
So you want to get a little out of it, right? But and it also depends on your the level of protection that you have. I mean, if you bought it for 13 or a very small number, then if it's 105 now, maybe you'd be okay with it, but you don't want it to go much below 80 or something, right? And then
Right.
So then you could. So what I'm doing is I'm kind of checking, like the 80 puts are 360. That's still pretty expensive in January. So then what you have to do is find something for about the same price on the calls. So, and that's the 142. So so it goes down $25 to the 80s, and then it goes up, and it goes up. Where was I?
So what you're doing with the calls is you're selling the call to make income to buy the put that you're using for the downside protection. Is that
Right.
typically on the same expiration?
Usually you do. You don't have to. I mean, some people will do that where they'll say, well, I'll just continuously sell the call, because there's more theta decay. The problem with that is it gets a little messy, because now we know for sure if we could do a zero cost collar. If it stays between that, there's nothing going on. Now, if it starts to go down, the good part about having a longer term call is there's more premium in there, and there's more delta usually. So you could start to then that helps cushion the blow, so to speak, as it starts to go down. So your put will go up, your short call will come down, so you'll be making pretty good profit on that short risk reversal / long put short call. So I generally like to see it in the same month, but that's a good question.
Got it.
So let's just look at what that looks like. So, and are you okay with 80? Like I'm using my arrow key so I could hone it. Now I could buy that right there, right in the trade builder is great because it allows you to. I'm up arrow key. So that's 350. So let's say the 142. So we'll get So now we're going to sell that call. So that's red. Oops. What do we say? The 142, yeah, red. So now, we're getting 25 cents. So what does that look like? So, that's a typical kind of long put, short call, and then the stock is over that. So, you still a long way to go to, call it 40, I mean, that's a good move, $40 up. And what is that, 25 down? So I mean, I think that looks pretty decent to me right there.
Yeah, I like it.
As a matter of fact, why don't we put this on? So the way it works in ORATS is you buy the shares first, and that's in the paper trading. I'm just going to pay the offer, and then we'll do the trade here. So that order was placed. We want to make sure we get filled. Yeah, so that got filled, and then we have it worth -28. We're taking in maybe 2 cents less. I think in the market that's reasonable, so we'll do that as well.
Pretty much costless.
Yeah. Well, yeah, better to us, right? So we're actually getting 26 cents. So another thing I think that's interesting to talk about for a caller, and this is a little bit more advanced. It's we talked about that. What we did there was kind of just say, hey, we should go out here. It looks like a reasonable amount of time, right? We could, but what? But we could have also gone out to June of next year or wherever. There are some tax considerations. It can't look like you're selling the stock. It has to be out of the money by a certain amount. And I would encourage people just to do their tax research separately. We can't really be expected to get into that because it's more individual. But you should look at that from a tax perspective. But we just kind of looked at it and we said, this is this seems like a good amount of time where we want to be protected. There's some other, if you want to get a little bit more scientific about it, that you could back test it. You could go look for an appropriate slope. So we'll talk about slope because this is a big slope trade, right, Tyler? I don't know if you thought about that, but you're really buying slope. So
we had a stock scan a while back that looked for undervalued slope, and we put on a short risk reversal for that strategy.
Right.
I want to tell a little story quickly, Matt.
Yeah, go for it.
About the caller strategy. I think NVIDIA is a great stock to pick here because it's one that has, it's been going up a lot, but you don't really know if maybe the AI bubble could burst and NVIDIA could come crashing down, or it could just keep on going up. And one thing I read recently about Mark Cuban, he was he's on Shark Tank. He's a popular investor, and he started several businesses. Back when he sold one of his first businesses during the .com boom and bust in the early 2000s. He sold his business and received it was over $1 billion stake in Yahoo stock. And he was very smart, and he did a caller trade on his stock that was granted to him, over $1 billion worth. And it really protected him because, as everyone knows, Yahoo went crashing down after that in the .com crash. And so he protected his downside by buying those puts. But he didn't waste a lot of money buying the puts because he sold the covered calls as well. So it's infamously called the Cuban collar trade.
Yeah, and that's a good point. There were some big trades on the floor when I used to be down there around the 2000s trading, and then I actually helped some people put on collars that made them a lot of money. So it's a good trade, especially some of these high volatility stocks, Tyler, where you could sell the call. We would call them low slopes, and we'll explain that. But so here are graphs of the 30-day slope. That 30-day slope of almost 2 seems pretty high this is the 2-year graph of slope. However, the infinite or 2-year slope is 1, and that seems about average or so.
Yeah. So Matt, for the viewers that aren't seeing how slope connects to the collar, can you explain a little bit?
Yeah, definitely. So let's put a collar in there again. It's generally, so here's a June collar. It's way out there. And then what we'll do? Well, in a second. Okay. So now the reason I did that is because when June's in there, I could show on the graph where the collar is. So does it help if I click into it like that? So each one of these dots you can see is all of the strikes. And so, that strike right there is what we're doing. And the strike over there, it's red, is also what we're doing. So there's the red one, and here's the green one right here. And so you could see that relationship. So this is implied volatility on this axis, and the low strikes to high strikes are on this axis. So it doesn't look like it's that different, right? And so sometimes they'll be very different, and you don't want to be doing this when the slope is high, is the point. So this research, the slope research, points to doing something a little bit longer term. And so one of the things that we do at ORATS is we show the slope for, I'm trying to click out of this, there it goes. We show the slope for every expiration. So March is 1.3, we went low. So here's 1.0, here's 0.9. So as you go out farther and farther, the slope gets lower and lower. So, I'd say somewhere around here is pretty good for this. You don't need to go to June, 600 days out. But the thing about going out to June is, and let's take a look at that trade again. You're selling the 152, buying the 92s. Again, that gets us a lot more protection than the 80s that we had before. So, again, not a horrible trade there. But anyway, that's the story of the slope. Mm-hmm. Like I said, we graphed it. We looked at it historically, and we found out. Yeah, go ahead, Tom.
For the visual learners out there, there's generally three types of formations in that graph right there, which is the implied volatility versus the strikes. There's sort of the left skew, which is what we're seeing now. It's very high volatility on the low strikes. And then a right skew would be something high volatility on the high strikes, which is not what this graph is showing. And then like a smile would be high volatility on both ends of low strikes and very high volatility right strikes, high strikes. And then you sometimes also see a flat skew, which is volatility is just sort of constant across the low and high strikes. And each one of these pictures tells a different story. And so this collar trade, we want to look at a very specific picture of the graph. And that's the one with the left skew, which is the one here.
Yeah, so, and you have to be careful because you're buying up on this high part and selling on this low part. So, you want something that's flatter, and then we found out where those are. Mm-hmm. So that's what I want to talk about, slope. And then I also want to talk a little bit about back testing, Tyler.
Yeah.
So another way to think about it is to run these risk reversals, because, you could run risk reversals in a lot of different setups. So the setups that I was looking at, and I did an optimized one. That's kind of cool. But I did 90 days, 10 deltas, 90 days, 20 deltas, 180 days, 20 deltas, and 360 days, 30 deltas. And then I thought I could throw even another 40 in there as well. Yeah, short risk reversal 40 days. So I was able to then combine all of those. Like, we have this optimizer, and what it does is it runs all of the back tests with all of the different criteria in each one. So I ran a total of 192 different variations. And some of the better variations were the 90 days at 10 delta, the 90 days at 20 delta. And you can kind of see that these are going to be negative because, the stock has gone up. But then when you combine it, so you're also then able to, like with a short risk reversal, you can combine it with long stock and generate a combined position. So you might say, well, yeah, that 10.4 looks good, but the Sharpe ratio is low. The highest Sharpe ratio is 0.86. And so, but the annual return is a little bit lower. So what that's saying is that, you're, and we could click on that one. So this is the one where you're selling kind of 30 delta, and selling 30 and buying 30. And so if you look at, you might look at that payoff picture, and would you be okay with that payoff picture? It doesn't. It looks like like I would have made $500,000 investing in 2007 in SPY, but you would have had also a lot of volatility, and you would have also been down almost to zero, or what were you down, like 30%? So
and that graph,
which
that
line do
graph,
you like, right?
yeah.
And you could compare that to the 10%, and this looks more like the stock graph, and maybe you like that better. But that's why there's not one size fits all. Like, so this is a one where it's the 10 delta. You're buying and selling the 10 delta. So that's pretty far out of the money. Like, so for right now, the last trade that it made was a while back, but the stock 544, it did the 490. So, you're losing over 10% there. So, if you're okay with that, then, then this 10 delta buying and selling, could be, but you wouldn't get called away until it was up 10% after 92 days. So that's a quarter. So that's a pretty good appreciation. Anyway, so it's which one do you like over this one? There's more volatility, 13.6, because if you're selling the out of the money calls and buying the out of the money puts, you're going to get more volatility than had you done something like closer to the money, because it kind of weighs against each other. So there's only 7% volatility. So you always should think of things in a risk adjusted returns, and anywhere around 1 Sharp, which is basically the annual return divided by the annual volatility. So it's 0.86. That's how you get that. And Sortino is just the volatility going down, only on the down move. So that's another thing to look at is to do these back tests, do the back tests in different underliers, and then you should start to think about what you're okay with. This is how you get smart on callers. This is how you get smart on protecting yourself, by seeing back tests, by doing what if analysis, by using your intuition where you want to, by looking at the graph, by trend lines and all that. That's what I think is the best way to approach the collar strategy, because it is very personal. It's how much risk you want to take, and it varies from individual to individual, who might have a lot of money in a particular concentrated position.
Yeah, I really like the strategy, Matt. I think it's great to do in this market, especially on high flying stocks like Nvidia. If you really believe in a stock and you have a lot invested in it, I think it's a good idea. Just the downside protection. You never know what's going to happen these days. Black swan events, and just a variety of things can happen.
Yep, absolutely. So I'll take a picture for next week, and we'll see how we're doing.
Great. Yeah, and you can also make this trade, just for a pure options play, looking at the slope, like Matt said. This episode was more about using it as a protective strategy, but at ORATS, we have a very robust option scanner, lots of slope indicators, forecasts of slope, and we have those built into the stock scanner to find these sort of caller opportunity stocks. So you can do that as well.
Yeah, but it's still a very long, you're long deltas. So, you could do it delta neutral, but then you get, then you don't have flat units. What I mean by that is, so the trade that we put on only gets us 38 negative deltas. So as the stock goes down, we lose 60 cents, which is kind of the net of, but we participate. We participate as well going up. So I've seen some collars that people put on, that are a lot tighter than that. That'll be like 70. And if you were doing a risk reversal and you weren't, you didn't have the position already, I would usually want to go closer to the money on these. So the delta of the underlying option position is closer to 100. Positive 100 is, the 100 shares. The meaning of delta is how much you make on a $1 up move on the stock. So, having a delta of 100 is 100 shares. So you make $100 if it goes up $1. If it goes with the option position, you would lose $38 if it went up a dollar. But so you bring up a good point, Tyler. If you're looking to make a trade that takes advantage of slope, you want to have a delta that's closer to a negative 100, because you don't want to take a lot of delta risk. Does that make sense?
Right. We've talked about this in prior episodes. It's kind of becoming a theme, is minimizing the Greek risk in your position. We've talked so many times about minimizing delta, minimizing theta, minimizing vega, like all these things, basically just trying to get to the underlying thesis as close as we can to the thesis. In this case, it would be slope.
Yeah, isolate your alpha.
That's a good way to put it.
Yeah. All right, cool.
All right. Thanks, Matt, for demonstrating that. And thank you, Tradier, for hosting for yet another week. If you guys have any questions, you can always leave a comment on the YouTube video, or you can go to ORATS.com, sign up, and leave a comment in the community tab, or just reach out to us at support@ORATS.com. We'll see you guys again next week. Thank you.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.